For the first application exercise in this module, there's just a couple things I want you to practice as it relates to preparing a balance sheet. And first, I'd like you to review the difference between temporary and permanent accounts. If we're going to prepare a balance sheet, it's important to remember which are the accounts that are permanent, whose balances are going to roll forward from one period to the next. At the same time, it's also important to identify the temporary accounts that are going to be closed to retained earnings and update its balance. So what I want you to do is prepare a single closing entry to calculate that updated balance for retained earnings. You could do this in multiple journal entries, but in my solution, I'm going to present one single summary closing entry. After you do that, I want you to prepare the current assets section of the balance sheet. So as you do this, I want you to comb through each of these accounts one at a time. Really mark this up and take note of which accounts are temporary versus permanent and which are relevant to the presentation of current assets. Now, as this is largely review from what you've seen in prior courses, I do want you to take a stab at this on your own. Pause the video now and give it your best attempt before going through my video solution here. Okay, let's take a whack at this then. One single closing entry to update the balance of retained earnings. And like I said, I hope you went through these one at a time, starting with accounts payable. Well, that's going to be a classic example of a permanent account. Accounts payable reflects our purchases on account that we still owe our vendors. Well, that's not going to magically disappear going from one period to the next, so that's a permanent account. Moving on to accounts receivable, also permanent. This is what our customers owe us. So we wouldn't want that to be close to zero at the end of the period. In fact, as you keep going through all of these, the first account that actually is temporary is going to be cost of goods sold. That reflects the expense of selling inventory to customers during the period. So ultimately, as I'm preparing this journal entry, I actually want to start with temporary accounts with an ending credit balance. They're going to be the debits in this closing entry. We're reversing their natural balance. And there's only one in this trial balance, sales revenue, $2.85 million. You can always expect there to be some sort of revenue account that we close to retained earnings with a debit. After that, we have 4 expense accounts, going from cost of goods sold to income tax expense. Then lastly, we have dividends. Now, dividends do not factor into the calculation of net income. They're not on the income statement, but they are period-specific temporary accounts. So dividends, along with all these expenses, have natural debit balances. Thus, we credit them to close them to retained earnings. Well, the thing that remains then is, how do we then update the balance for retained earnings? What I would recommend is find the sum of total debits so far, subtract out total credits, and see if you have a need for more credits or more debits to make this journal entry balance. When you take 2850 and subtract out all of those credits in this journal entry so far, we still need $150,000 of credits to make this balance. So retained earnings is going to increase as a result. And that makes sense, right? If our sales exceeded our expenses and dividends, then that's going to lead to an increase in the overall equity of the company. If retained earnings is increasing by $150,000, we can go down in the trial balance, find retained earnings, and see that it ended with a pre-closing balance of $770,000. When we add $150 to that, we have a post-closing balance of $920,000. Very good. Well, let's now move on to presenting current assets on the balance sheet. And just to quickly identify which are the relevant accounts, I'm going to bold them and kind of highlight them in red here. These are the accounts that are relevant. If you need a sec to go back and check your work, feel free to make any revisions at this point. But remember, with current assets on the balance sheet, we need to present these in order of descending liquidity, how easily they are converted to cash. So, thus, cash and cash equivalents, it always is going to come first, definitionally. After this, we could find short term investments. Now, you're going to study investments quite a bit more in Accounting 3020. But for now, I think it's safe to say that you're ready to understand the principle that companies have to designate all their investments that they hold, stocks and bonds, as either short term in nature or long term. Do you plan to sell these within the next year, or do you plan to hold them to maturity or past 1 year? And for those marketable securities that we're holding just for the short term, those are very liquid current assets. Next, we have accounts receivable. And I want you to take note that I am presenting a net number here. So going back to the trial balance, when we talk about gross accounts receivable, that's the total amount that you are legally entitled to receive from your customers. But under US GAAP, companies must not just present what you're owed, but what you actually expect to collect from your customers. So taking this 380, we need to subtract out this allowance for doubtful accounts to thus present accounts receivable at its net amount. Okay, further down in the liquidity food chain, we've got inventory. Yeah, we've got to sell it first and then collect the cash from those sales. And then our last current asset here relates to prepaid expenses. We got to remember that prepaid expenses are in fact assets, and we expect to consume them typically within 1 year. Now, I say consume because we're not going to be converting those into cash, so they're typically thought of as our least liquid current asset. When we add all these up, you should get total current assets of 1.2 million. And that's great. Having this classification, knowing the total current assets for a company, that's a useful metric. We're now in a better position to understand a company's ability to meet its short term obligations.